The U.S. productivity has been slowing a lot over the years. You say that Grand Theft Auto and what we've seen in that 16-year span explains this chart of why productivity is slowing down. How does that work?
I just put it slightly more broadly and say that, in general, I think the statistics don't do a good job picking up quality improvement, especially in software and digital content. I think there are some issues in technology more broadly, even on the hardware side, but it's really primarily about picking up quality improvement in the deflators. So what the government statistics basically do is say, you know, version of a software program this year costs the same as what it cost 5 years ago, so there's no change in price, and there's not really a strong effort to adjust for quality improvement. I mean, mainly because it's just very difficult to do. It's just very, very hard to do, but conceptually it really should be done, and that's something that should show up as productivity growth, but doesn't.
So when you take a look at the productivity growth, what should that number be for around, 1.7%?
So we've tried to come up with a ballpark estimate, and this is very difficult. But when we look at the different areas that we think are subject to bias, we're coming up with about 0.7 of a percentage point of missed productivity growth. I mean, that's, I don't want to be so precise about it just because there is a lot of there's a lot of uncertainty around it, but that's the order of magnitude by our estimates.
And so what are the economic ramifications of that big of a difference in where productivity is currently measured and what you think it is? Does it affect inflation and the Fed and the like?
Well, I think it does a few things. There's one very clear implication, which is that when there's a lot of uncertainty about real GDP growth and productivity, then real GDP growth is probably not the best measure of how well the economy is doing. It's better to focus on the labor market numbers. We can count people, and we can count hours worked pretty well, but we can't count real inflation-adjusted dollars of GDP all that well. So I think that's number one. Number two, most of the, possibly all of the counterpart of mismeasured productivity growth is mismeasured inflation. So inflation is even lower than the already very low official numbers. And that potentially has some dovish monetary policy implications. I think that part is going to be something that's not going to have as big an impact in terms of the practical debate, just because this debate is still in its early stages. But the focus on the labor market, I think, is very important.
But all things being equal, it would suggest that there's less urgency for Yellen to hike.
That's right. Yes. So it does go in that direction. And again, I don't think it's going to have a big practical impact at this point, but it does go in that direction.
Well, when you take a look at, say, IT contribution to productivity, what is the benefit there? I mean, what do we see and what should it be and how do we fix it? And that's pretty low.
Yeah, it's very small. And, if you look back at the 1980s, in 1987, Robert Solow, basically the father of modern growth theory, said in 1987 that we can see the computer everywhere but in the productivity statistics. And in fact, the measured productivity, the measured IT contribution is even lower now than it was back then. So that sort of Solow paradox about productivity looks even more extreme now than it did back then.
On a different topic, one of the big questions is the economy finally going to tilt back to labor so that labor finally gets some buying power or bargaining power, gets wage growth? Where do you see that happening?
I would expect that we get at least some move back in the pendulum towards labor. I mean, how much of the erosion in labor's share of GDP gets reversed over the next few years, I think it's hard to be very confident about that. But directionally, I would expect somewhat stronger wage growth as the labor market improves further, and therefore ultimately also stronger real income growth.
We asked this question of Professor Blinder as well. What keeps you up at night?
I mean, I think in the U.S., in the domestic economy, I'm not particularly worried about big imbalances. So it's mainly about external influences. And I'd say when I look at the world economy, the area where the imbalances are biggest is probably China. So from a domestic perspective there, and from kind of global average GDP growth rates, that's probably the place to worry most. In terms of spillovers to the U.S., I think you probably still would have to say Europe. I mean, I think things are getting better, but there are, of course, still some risks there. Greece is not yet totally sorted out. The periphery crisis could come back,
Okay.
and the linkages between Europe and the US are much tighter.